What if I told you that you can legally pay 0% tax on the profit when you sell property in the Czech Republic? Most expats or even Czechs don't know this is true. Czech property taxes are too good, but not for the government, for you. Today I will explain what taxes you might expect and how to legally avoid them. Ready? Let's dive right into it. There are two different types of taxes on properties in the Czech Republic. It is your annual property tax and then your income tax, either from sale or from the rent. Property tax is paid annually and depends on the size of the property and its location. In Prague, you can expect anything between 2 to 5, maximum 10,000 Czech crowns per year. Yeah, that's right. If you compare it to the US, for example, it's ridiculously low. And I know in some other countries, the property tax is a significant factor to consider. In Czech Republic, is relatively low. The income tax is something calculated from your profit, which is either on rental, annually, or upon sale, if you make a profit. The tax is 15 to 23%, depending on your income, but the beauty here is that there are ways how to reduce these income taxes effectively to zero. And I mean legal ways, which I will explain right now. You cannot really avoid the annual tax, but it's small anyway. So let's talk about the income tax. This is where the magic happens. So how do you get to 0% tax? First, let me cover the exit. When you sell your property and when you make a profit. Have you ever heard anything called the time test? No? Well, it will be your best friend when selling the property, so please meet each other. Time test is, guess what? Amount of time which needs to pass between the purchase and the sale upon certain conditions. And here we have to be specific because I will be speaking about 3 different time horizons, plus as a bonus, how to avoid them entirely. Time test number 1, the residency test. If you live in the property 2 years prior to the sale, no income tax. Big round 0. Hold on. You mean if I buy a property for 10 million and sell it for 12 million in 2.5 years, I pay no income tax? That's correct, as long as you lived there for 2 years prior to the sale. Test number 2 for investment properties or properties where you did not live. This time test increases to 10 years instead of 2. Quite a jump. If you own an investment property which you rent out, you need to wait 10 years before you can avoid the taxman. And test number 3 is what many people remember. It's 5 years, which is the old rules in effect until January 2021. Anyone who bought the property before this date has the 5 years time test. These days it is 10. If you own the property which you bought before, well, realistically these days you are already past the time test. Double check with your accountant, double check the dates on the land registry, but you should be safe after 5 years if you bought before 2021. Now, what if I do not fulfill these? What if you sell the property before the time test passes? You have to pay the tax, right? Well, luckily, there is another paragraph of the law which says if you use the profit to buy your primary home, you also avoid the tax. Yay! I told you, it's too good. If you know how to play the game, there are huge profits on the property appreciations. Now, I'm not a tax advisor, so always double check with a professional, but I'm 99% sure what I'm saying is right, but of course the rules can change. When it comes to rental income, it's a little bit more complicated. Because if you receive a rental income, and I don't mean Airbnb, regular rent, then you have 2 options. You either use flat tax regime, meaning you tax 70% of the rent. If you have 100,000 per year on a rent, then you tax 70,000 with the tax of 15 or 23%. That's the easy way. Or you can use real costs, where you will deduct from, in this case, 100,000, whatever costs you had with the apartment. If you have a mortgage on it, the biggest cost will be your interest to the mortgage. Unlike for private ownership or for own living, where you deduct the interest from your tax base, here you use it as a cost. So realistically, from the 100,000, 80,000 was paid on interest, for example, well, and you tax only 20,000. These days, when the interest rates are so high, sometimes the interest is even more than the year. So you will get to zero. And you might be thinking, is it even worth to buy a property if the interest is more than the rent? Well, yes, if the property appreciated in value. And there are other costs you can include in your tax return. For example, property management fee if you have a company looking after your investment. And also, I think insurance, there is multiple things, but double check it with your tax advisor or with ChatGPT if you want, but better, of course, the tax advisor or directly the financial office. Long story short, you are able to get to zero in most cases. And then the last thing, what if you bought in cash? What if the mortgage is maybe from times before and now you really have some income to tax? Well, there is another trick what you can use. It's called property depreciation, but it's a little bit dangerous because what you're doing over a long period of years, you're depreciating the value of the property in accounting language. And let's say that the rental income is 100,000 and according to the books, and again, ChatGPT is your best friend, you will figure out how much you can depreciate the property. You have to put it to the tax return and effectively, it will be more than almost any rent. So this way you're effectively in loss. Watch out, because some banks don't like it in future if you want to use rental income, because you're technically in loss. That's one danger, but the bigger danger is if you would not fulfill the time test, then the profit is not calculated from the purchase price, but from the depreciated amount. So if you bought it for 5 million, you depreciated 500,000 and you sold for 6. The tax wouldn't be calculated from the 1 million profit, but actually from 1.5, because it considers also the depreciation value. The rule I would apply here is use the depreciation only if you're certain that you will use the time test or you will pass the time test, because otherwise you will end up paying more on the tax. And if you're wondering, what about Airbnb? Is this also under the same rules? No, it's not. It is much more complicated, and actually I did a video about it. You should be able to see it here. And if you want to know what are all the costs and how it works for Airbnb properties, this is where you will find all your answers. And if you want to buy as a company, I wouldn't go this way. I mean, there are cases where it might make sense, but buying a property as a company is a specific situation. Usually people don't do it until they have a valid reason for this way. This you should definitely consult with your tax advisor, because there can be VAT in play. There is no time test at all if you buy it as a company. So generally the rules are worse, in my opinion. And again, this is a topic which is too complex, and consult it with your tax advisor. My name is Robin. I'm advisor for expats who want to buy properties. And if you want to know any guidance on what properties should I buy, does it make sense to use a mortgage, or should I buy for Airbnb or for long-term rental, these are the conversations we're having with clients. If you want to know more, check out the description below. There is my contact details, and see you in the next video.